$1.8 billion of shopping centre write-downs. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. I've got my morning stein of coffee, and I thought we'd have a look at this article from news.com.au, which is discussing Vivinity Centres and their nearly $1.8 billion devaluation or write-down of their shopping centre assets. Now, we've been discussing this for a while. Since the beginning of the year, it felt like it was one player after another entering voluntary administration. Retail had taken a hammering. Remember, it was a boutique one, then a boutique one, then another boutique one. Oh, look, such and such group is facing huge numbers of bankruptcies or failure to pay rent from their boutique tenants. Then you've got some of the bigger chains, the bigger brands, shutting down stores all across the country again and again and again. And then finally, we start seeing some of the anchor tenants, some of the big boys, the draw cards of these centres, the reason you go to them, you put up with the parking, you're frustrated with the travel, are either closing up, reducing their footprint, or leaving. And I've been asking, is this going to have an impact on the valuation of some of these businesses? Because with the shopping centres, with anyone in this property sector, their tenancy rate, their occupancy rate affects the value of it. The amount of money they're returning affects the value of it. So a big write-off like this, I can't say is entirely unexpected. Although some people said, no, it'll go good. But we'll have to see how this goes forward, particularly with the cultural shift towards online shopping. Now, before we have a look at the share price, I'm going to have a stein of coffee. Good coffee, guys. Good way to wake up in the morning. Half a litre of strong black coffee. So let's jump over here, and we can see the share price has retreated 2.49%. The P/E is 4.38. We'll jump out to 5 years, and you can see, their peak in July in 2016 was about 350. Beginning of this year, end of last year, they were sitting around 250. So they're nearly at half. What did they dive to? Yeah, well, they lost half the value. So has the market anticipated this write-off, this devaluation already? And we see that here. So it anticipated a few months ahead of schedule, and it sprung back up. So we'll have to see, guys. We'll have to see, because they're not the only players that have been making strategic moves in this area to just divest out of some of these less performing shopping centres. Shopping mall owner Vivinity Centres devalues its property portfolio due to the pandemic. Well, due to the economic restrictions resulting from the pandemic. A major shopping mall owner has warned the value of its property portfolio has been hit. Did anyone short them, guys? Let us know in the comments if you shorted them. Major shopping mall owner Vivinity Centres has warned the ongoing economic downward spiral sparked by the pandemic has forced it to devalue the worth of its property portfolio. Now, this is just one centre. What would happen if the banking sector did that? If all of a sudden our houses got devalued? In an update to investors on Friday, the owner of Melbourne's iconic Chadstone shopping mall said its swath of properties had declined by 11.3% at the June 30, reflecting the financial woes caused by the pandemic that have changed the retail landscape. The decline represents $1.79 billion of its portfolio's total value, which is made up of 60 directly owned retail properties. Now, here's an interesting one, because we've been looking at or discussing these REITs for some time, just because it's a great way for people to get exposure to this retail sector, to own a piece of Westfield, to own a piece of the shopping centre. Is there a way, is there an investment trust, an ETF, exchange traded fund, that just holds the job agencies, that just holds those, as a pipe way to try and get a slice of all this government stimulus for employment? I'm just putting it out there. Let me know in the comments if there is. It may not be the most ethical type of investment, to be honest. I'd rather coal plants and nuclear plants and all these other things that people are scared of. But still, Vivinity Centres owns Melbourne's Emporium, Sydney's CBD, the Galleries, and Brisbane's Queen's Plaza and Maya Centre. The group said its flagship portfolio, which includes Chadstone's premium CBD retail and direct factory outlet centres, had only declined 8.8% in value. Vivinity Centres Chief Executive Grant Kelly said the smaller devaluation of flagship portfolio affirmed the company's long-term strategy of retaining more properties in metropolitan markets. Well, at the moment, the long-term, you can't argue that well, it's performed worse than others, I guess, and that's how they're comparing. They're saying the metropolitan markets will have to see the long-term impact. Maybe it would have been smarter to invest purely in logistics, to have a way for your tenants to decant out to a internet-only model. A portion of the valuation decline in the period relates to the assistance in the form of rent waivers provided by Vicinity to retailers impacted by the pandemic, he said. It is important to note that retail property is one of the few industries where partial rent waivers, not just rent deferrals, are being offered to impact the businesses, notwithstanding legal obligations under lease. Well, isn't that nice of you? Isn't that so nice of you? But I mean, it's retail, guys. It's retail. Australian retailers were hit hard by the initial lockdown measures introduced to combat the virus, forcing a large proportion of the industry to shut up shop and negotiate rent reductions with shopping mall landlords. Well, the time of the instant yearly increase in the rents, I think, is going to come to an end. I don't think we'll see that anymore in these centres. Rent reductions have been a driver of lower rental income brought in by landlords such as Vicinity Centres. According to its update, the group's regional assets fell 15% or 756 million in value to 4.1 billion. Mr. Kelly said more people were returning to shopping malls with the easings of restrictions, but the threat of a second wave, we've got a second wave in Victoria, it's not even a threat anymore, made it difficult to forecast the total impact of the crisis. This remains a highly uncertain and evolving environment, as demonstrated by current circumstances in Victoria, he said. Any reductions in discretionary retail spending and lower retail activity may continue to have an adverse impact on the valuation of their assets. And what we're going to do, I mean, they've pushed out JobKeeper, they've pushed out the job seeker, they've pushed out bank holidays. Once they start tapering off, once we start up to September, it's even, your free money is going to be less. So that will have to have an impact on retail spending. It's going to have an impact on the valuation of these. So the question I put to you, those of you that are more experienced in trading than I am, is this decline here, is this the market anticipating this devaluation of their assets that we saw here? I mean, we've had about 11% devaluation, but nearly a 50% fall in the market valuation. Is this telling us that they anticipate further devaluations coming down the road? Further decline in profits for the company coming down the road? What's the kind of lag time in these type of market movements? Or is it just a reaction? A reaction, everyone needing their money, needing to get out of it. I mean, because the market's an interesting thing, particularly when you start reading about psychology and just the behavior of mobs. I mean, look at Robinhood. Look at Robinhood and Hertz. That's just, I'll try and find the chart again. I'll try and find the chart again. Here we go. And we can jump here. And you can see, we discussed this in a previous video, as Hertz went down, pretty much a bankrupt company, tied purely to airlines, a big portion of it, and tourism, the retailers just plowed in. Look at them. Look at the amount of holding, because Robinhood's a free trading app that you use on your phone. Apparently everyone at Wall Street Bets uses it to make like insane moves and go millions in debt. So, I mean, it's terrifying hearing some of the stories there. So, one thing I'm worried, we're going to see, we'll have to watch, what's the Australia equivalent? We can see how many noobs jump into Vicinity Centres, or the fact that you've got, also something happening now in silver and gold shares. That means is this a good counter signal? So as always, guys, please let me know your thoughts and opinions. What do you think? Do you think Vicinity has been, their price has factored in this devaluation? Or are we going to see more in the future? Do you think retail is the way forward? Do you think there's even any hope for retail? Would you be investing in it? And do you like the fact that the state is bailing out a lot of businesses? Although, you know, I guess that avoids them getting sued for shutting them down. As always, let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using any of our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, guys. I'll see you in the next episode.